I want to talk about health savings accounts. These were signed into law in 2003 for the 2004 tax year by President George W. Bush. So they've been around for over 20 years. The original limits were $2,600 for an individual participating in a health savings account. If you had family coverage, it was $5,150 that first year. Now, these numbers have nudged up very slowly over the last 20 years. In 2026, single members can contribute up to $4,400. Someone covering a family can now contribute $8,750 to a health savings account. If you're over the age of, if you're 55 and over, you can add an extra $1,000 to that amount that you're contributing. So look, if you've got family coverage and you're 55 or over, you're getting close to $10,000 a year that you can put away in a health savings account. I know these things start out very slowly, but if you had been doing this as an individual, $2,600 a year, even if you just did that for the last 20 years now without any kind of compounding, you've got $52,000 sitting in a health savings account. These little accounts can really start to add up. To be eligible for a health savings account, you need to be participating in a high deductible healthcare plan through your employer, or you need to be enrolled in what's called an HSA eligible plan if you have your own coverage. Now, look, healthcare plans in 2026 are plenty expensive, but a health savings account, an HSA, might be worth considering. You need to know that the contributions go in on a pre-tax basis. The amounts that are in your plan compound without any kind of tax involved. And when you go to take your distributions, if they're for medical expenses, that money is not going to be taxed. So a lot of times you'll get advisors who talk about this triple tax-free uh, feature. Yeah, this is actually a pretty decent plan. Now in 2026, a lot more healthcare plans are becoming high deductible plans. That's not great. But a side benefit to that is more and more folks are becoming eligible now to enroll in a health savings account. But it might just be cash flow that's stopping someone from doing this. You've got to pay a lot of money out of pocket. And then, the premiums go up every year. And then to think about putting money into a health savings account on top of that, uh, it might be a tall order for some. But let me just give you some numbers. As of 2025, there were 40 million participants in health savings accounts. That's way more than I imagined when I started putting my numbers together for this video. The total amount of money from those 40 million participants in health savings accounts adds up to $159 billion. That sounds like an awful lot of money that's sitting in health savings accounts. But if you do the math, the balance on average works out to be just a shade under $4,000 per account. What's going on here? Well, I imagine that some people are using this as expenses come up. And so you'll see cash go in and then you'll see cash coming out right away for healthcare expenses. One way to consider approaching these health savings accounts is to make the contributions, but pay your expenses as you go out of pocket and try not to tap into the account. Let the account just compound. To save every single receipt that you get where you paid something for medical care out of pocket and save these for years. Here's why. There's no deadline on submitting claims. Like, if you have a flexible spending account, it's use it or lose it in that calendar year. You've got to have a healthcare expense and then submit the claim right away. With a health savings account, there is no deadline like that. So suppose you're approaching age 65 and you hit your max out of pocket when you were 59, 60, 61 years old. That's 3 years. My max out of pocket right now is $7,000 per year. If this were me and I had 3 years of max out of pocket, that's 21 grand that I can withdraw at age 65 from my health savings account, no tax. If you make a withdrawal from a health savings account for a medical expense, there is no tax that gets associated with that. But if you were to take money out of a health savings account and you didn't have a medical claim attached to that, you need to know that there's a 20% penalty, 20% penalty on top of it, the withdrawal being taxable income to you. Try not to do that. You also need to know that at age 65, you don't necessarily need a medical claim to or receipts to take money out of a health savings account. It's just going to be taxable income if you don't have a medical claim attached to it. It works a lot like an IRA. Once you apply for Medicare, you're no longer eligible to contribute in a health savings account. If you don't apply for Medicare around age 65, I should probably do another video on that topic alone. There's a lot of things that could go wrong. But if you don't apply for Medicare at age 65 and you're still participating in a high deductible healthcare plan, you may still be eligible to put money into an HSA. If you're covered by TRICARE, if you're in the military, you're not eligible for an HSA because it's not a high deductible healthcare plan. Folks, by the way, if you're in TRICARE, you're eligible for something that's called an healthcare flexible spending account. That might be something that you could take a look at because you can put away up to $3,400 into a plan like that. Also, if you or your spouse participates in a flexible spending account at work, you may not be eligible for a health savings account. A lot of moving parts for small accounts. It doesn't sound like much because it's the dollars seem small, but like Roth IRAs, like IRAs when they first began, like 529 plans, a lot of these plans start out with small dollar amounts, but over time, these plans get expanded. It's something you really shouldn't ignore. And a health savings account, I think, is something that it may be worth a look.